Ladies and gentlemen, welcome to another edition of the Independent Speculator Live. My name is Lobo Tigre. I am the Independent Speculator, and I sure hope this thing is working. I like to do these when I have something to say, as opposed to just on a regular schedule whether I have anything to add or not. So it's been a while. Somebody give me a thumbs up. Okay, I've got a thumbs up. We're live. Welcome once again. Now, I have a bunch of questions from people who wrote in advance, and I hope I'll get a bunch more from you live. I'll try to interweave those so that it's not all one or the other. But before I do that, I have a few in the announcement and the broadcast, but here we are. So the first thing I want to say, and this is kind of a hobby horse of mine, forgive me if you've heard this before, but I think it's really important. At times like this, where markets are melting down, things are going haywire, up, down, sideways, things don't always make sense. It's a time where the gurus sort of come out of the woodwork and make their bold predictions. I saw a prediction this morning that 2020 is going to be finally the crash of 2008 revisited, that this is, the other shoe that many of us have long been waiting for is going to drop. This was not, by the way, my former employers. The thing about something like this is, if this person is right, they'll have bragging rights. If we have a big crash in the future, they'll be able to say, oh, I'm the one that predicted the crash of 2020. If they're wrong, we won't know that for another year, and by that time, they've already got your subscription fees, or they've sold whatever they're going to sell. They move on to the next crisis. I call this the prediction racket, because the consequences for making bold predictions and getting them wrong are separated from the sales event that often goes with these bold predictions in time. And this just strikes me as, I don't know what else to say. It's unethical. I don't want to participate in that. If I have no pecuniary gain and I'm just making bold predictions, fine. But if I have something to sell, which I do, my purpose for being here, quite frankly, is to be so bloody useful to you that you decide you want to subscribe to my newsletters. So I don't want to join the prediction racket. And in a context like today, where people are going to say, oh, what do you think? Is gold going to go up, or what's going to happen here? The temptation to make these bold predictions is huge. That doesn't mean we don't have anything to say at all, however. The way I like to look at this is, instead of making bold predictions, which may or may not be right, I want to look at the trends that are in front of us and say, okay, this is what's happening now, and this is what I can or cannot say based on what is happening now. So that's my context here. If you want my gold price at the end of the year, you've come to the wrong place. I'm not doing it. Those are made up numbers. They don't matter. Great sales gimmicks, but that's not what I'm all about. Okay, now, the news of the day, of course, is COVID-19, the coronavirus outbreak. Now, this is one more thing I have to preface, sorry, but every time I write about this, I get hate mail. I get people who pile on me for being a fearmonger and talking up something that's no worse than a common flu, and I'm making things worse by talking about this at all. And I also get mail from people who are saying, what's wrong with you? This is the worst thing since the Spanish flu 100 years ago. Why are you just talking about the economics? People are dying. Have you no heart? I can't win. But the reality here is that I have to talk about this. It is having an economic impact, which is what brings us together. Okay, as a human being, yes, I feel for the afflicted. People have died. I feel for the bereaved. This is a big topic that I don't want to untangle. I'm not a doctor. I'm not an epidemiologist. I'm just a speculator. That said, this does have economic consequences. I can't not talk about it. It's my job. What you want from me, if you want anything from me at all, is, to the best of my ability, to call the shots as I see them. And this is something that's determining a lot or impacting a lot of our investments right now. So I can't not talk about this. So please, whichever side of this you fall on, if you're it's the no worse than the flu side, bear with me here. I don't want to be, making a mountain out of this and the investment implications of what is going on in our world today. That said, I'm going to decloak here. I'm trying to be neutral. I'm trying to be in between. But I will say that personally, this is a personal comment, I do find this outbreak to be quite serious. Yes, even if it's no worse than the common flu. The common flu is a serious thing. The common flu kills people. The common flu already has hospitals full of people suffering from the common flu. So if on top of that you add something else, this is significant. And I'm not a doctor, but when I saw and when it became evident that this particular flu spreads before people are symptomatic, this asymptomatic spread, that's a big deal. That makes it pretty much impossible to contain. You don't know you've got it. Why would you stay home? You've got work to do. You've got shopping to do, whatever. Why would you stay home? You don't even know you're sick. And by the time you do know, you've already given it to who knows how many other people. When that became clear to me, I thought that this thing would be serious. I thought that the economic impacts would be substantial and they would be long-lived. For a while when this started up, a lot of people were saying, oh, it's just another flu. It's going to be Q1. And they seem to have got it under control over there. I hope that's true. But even if it is true, that's China, which has a command and control economy where they can just order people, tens of millions of people, to stay home. And they have the police state to make that stick. You don't have that in India or most of Africa or even in the United States. We've got a Bill of Rights here. I'm not sure that you could do here in the United States half of what the Chinese did to get this thing under control. Now, I'm not trying to be a fearmonger here. I'm not saying, global pandemic, we're all going to die. Not saying that at all. I am saying that it is a mistake to dismiss this thing as nothing. It is not nothing. The flu is something, and this is a bad flu. Particularly if you're older. This is something else that we do know about this. If you're over 60, this is not just a common dismiss it cold that you can not worry about. If you're over 70, it's really quite serious. And I would take active measures if I was in that age group to avoid contact with others until this thing blows over. I'm not a doctor. I'm not giving medical advice. I'm just saying personally, if I was in that age bracket, I would really, why take a chance? Just why take a chance? And even at my own age, I'm older than I look. This is more serious for me than it would be if I was 19 in the peak of health. So why take a chance? Enough said on that. I'm not going to focus on the medical thing. I just really urge people not to dismiss this, particularly if you're in a vulnerable age bracket. Why take a chance? Okay, so this is having and will have broad economic impacts. Now, there's a lot that we can say about that. A lot has been said. I've put a lot into my last 2 weekly emails. There are charts and figures you can look at. But the one thing that's clearly obvious to me about this is that this is going to be good for gold. Now, again, on the human side, I don't want to seem like I'm profiting from other people's misery, but hey, we didn't create this virus. I'm not spreading the virus. I'm doing my best not to spread the virus. It is what it is, and we don't do anybody any good by ignoring the trends and letting them steamroll up. The economic damage that I see on the horizon, whether it pushes the global economy into a full-blown recession or not, it's bad. It's a hit. It's fearful. It's going to generate fearful headlines for weeks and possibly months. That's very bullish for gold. So that's the thing itself. On top of that, you have the government response. And apart from the draconian measures that appear to be necessary to get this thing under control, there's just the economic response. We've already got the Fed with their panic rate cut. We've got central banks around the world already easing money and likely to respond even further than that. All of this is extremely bullish for monetary metals, for gold and silver specifically. Monetary metals, not just expensive metals, not just dear and precious metals, but monetary metals, gold and silver. I don't see a scenario how this plays out where it's not good for gold and silver. Okay, suppose the powers that be intervene, they completely stave off a global recession. Way, yay, yay, happy, happy, joy, joy again on Wall Street and London, fine. But the price for that is easy money. The price for that is currency debasement, and that's good for gold and silver. Now, if they don't manage to stave it off, if things do get worse, then the fear goes straight into the aorta, all that adrenaline straight into the aorta brain. Monetary metals, I don't see how we come through this, whatever is in front of us, without it being very, very good for gold and silver. I see new nominal highs in gold are now an easy target to hit this year, possibly in silver as well. But silver, as we all know, typically lags behind gold, but it will have its day. So that's often a question, what about silver? Is silver now an industrial metal? I've written quite a bit about this. You can look up silver on our website. Silver's Day is one particular article. But it's common to see silver lag gold. There's absolutely no question based on market data just from this last week. Market action tells us that silver is still a monetary metal. It still moves with gold, and it will follow suit. If gold has gone up, the underlying value in that company has gone up, it makes no sense for the stock to go down. Gold itself is physical wealth, that you can hold in your hand. As my mentor, Doug Casey, liked to say, it's the only financial asset for which there is no short to counter your long. It's not simultaneously somebody else's liability, gold and silver both. So we own gold for prudence. We own gold as a safe haven. Personally, gold is where I put my savings, and I think of gold as money. So we'll come back to that. But when I say go to cash, that includes gold in my mind, not just funny little green pieces of paper or whatever color they are where you live. But that's one thing. The stocks are another. Stocks are risk assets. And even if a gold company should make more money with gold prices going up, who knows? Maybe the government in that country will do something draconian that affects the gold miner. They could shut down the mines because workers coming together could infect each other. It is possible that any number of things could affect gold exploration or production companies that would not affect the metal itself. A stock is a risk asset, even if it's a gold stock. So it's not surprising to see gold stocks sometimes move in opposite directions, particularly in the early days of a market, crisis that's shaping up as we see. So don't panic. We've seen this before. It happens. Don't worry. If the underlying commodity keeps going up, that will eventually drag the equities with it. If it's a good company, well managed, if it's a producer, it should come out fine, whatever the short-term volatility is. If it's an exploration company that's really got the goods, by the time that becomes a mine or becomes a takeover, this whole coronavirus thing will be behind us. So really, when it comes to the gold stocks, I have no question about these things. I took some profits. I'm not liquidating my whole portfolio of gold stocks because I'm not worried about the quality companies that I have right now in my portfolio. I'm not buying more because there's clearly risk of downside, but I'm not liquidating my gold stocks. But I am aware that they could be in for a very rough ride before things get better. Where that really brings us to is kind of a market timing question. As you all know, I don't like to try to time markets. My take on this, though, is that, let me rewind for just a second. I'm getting a lot of messages who are looking at the bargains on the table now, and they're really tempted to buy. And I confess I feel this temptation myself. If I liked a company at $5 2 weeks ago, and now it's trading at $3 or $2.50, it's a better deal. I like it better now. So I'm not throwing that conventional wisdom out the window. If there's nothing has changed fundamentally in the company and the stock is 50% cheaper, it is twice better a deal than it was before. Absolutely. No argument. I agree with Rick Rule on that. But that doesn't mean it can't get cheaper in the near term. And why would it get cheaper? Well, because we don't know how the crisis is going to unfold. And whether it's something like force majeure that I was talking about above, where coronavirus directly causes an impact on a producer, or whether it's margin calls or funds facing redemptions, or just people panicking out of risk assets in general, it's entirely possible that we could be in for a lot more pain before this thing bottoms out. In saying that, I am very conscious that there are fantastic bargains on the table right now. Yes, I feel it. I'm tempted by those. And if I don't take those now, they could get away from me. Yes, I get that. They could get away from me. But if I buy now and they go on sale even another 50% or another 50% from there, fantastic companies went on sale in 2008, 90% off, 95% off. I remember Techcominco went from like $60 to $3. I mean, if we're in for another 2008 style event, that could happen. Nobody can tell you that that's not going to happen. So where does this leave us? If you buy anything right now, you have to go, like after you get off this call, go look yourself in the mirror and say, I'm happy to buy this stock and willing to see it drop 50 to 75% from here, and I'm okay with that. Now, if you can do that and not wince, not blush, not look away from yourself, if you can do that and you're okay with that, you're convinced that this is a great company that's going to pull through whatever comes in front of us, fine. You don't want to miss out, go for it. I'm not doing that myself. I'm willing to miss out on today's bargains because it just seems to me that the causes that have brought these bargains to the table have not changed. They've not gone away. Okay, maybe China's telling the truth. Maybe it's under control there. Maybe this thing, has peaked there, but it sure as heck hasn't peaked anywhere else. The curves now, both of the case rates and the fatalities, are accelerating upwards again. So, again, whether it's any worse than the common flu or not, that's the reality. These curves are upwards. The negative headlines that we've seen that have caused the situation over the last couple of weeks, we have every reason to expect those to be worse in the weeks ahead. So I am not looking at a safe smashed on the street right now. I'm looking at a safe that I still very much see in free fall. I could be wrong. That's how I see it. That's how I am playing it with my own money. So just remember that the gold stocks are not gold. Uranium as clearly not entirely insulated from a great recession if we have one, or a greater recession. But its fundamentals are different. And even if people are not going to work and they're staying at home, or all kinds of crazy things happen in the weeks ahead, they're still going to want the lights to come on at night. They're still going to want their microwave to heat up their dinner. So, yes, industrial power. So I see it as relatively insulated from whatever's going to happen to the global economy and the U.S. economy. And I see the fundamentals, not changed at all. You cannot mine the stuff except in Kazakhstan, and who knows for how long there, at current prices. So that has to change. And that could easily change even in a global economic recession. Once the utilities draw down their inventories to the point where, they're no longer comfortable with what they have, or their spreadsheet tells them, you have to have more inventory on hand, or you can't depend entirely on Kazakhstan for your supply, those buyers will be forced back to the table, and none of the miners are going to sign contracts with them at anywhere near current prices. So I do see uranium as different. Doesn't mean it's going to rebound tomorrow. The only other thing I've got to say about that is forget about this nuclear fuel working group thing. Even if it's true that they're finally going to publish that report, which is late again, disappointed people again, even if that's true, it's not up to them to implement any of these things. Congress is going to have to act, and Congress is split right now. There's no way the House is going to cooperate with anything Trump wants on this front, and it is not a sure thing that Trump's going to win re-election. To the degree that the U.S. does get into more economic trouble in the months ahead, even if it's self-inflicted panic over the virus, doesn't matter. If it happens, it happens, and that's going to make it very difficult for Trump to get reelected. I'm not predicting that he'll fail. I'm just saying it is not safe to assume he will be reelected. So none of this Trump nuclear fuel working group business, I don't think it matters at all. It's a non-variable. Stop buying stocks just because of some nuclear fuel working group rumor, please. Wait for the fundamentals. Wait for prices to start rising. We haven't seen that yet. In fact, on Friday, they were down 13 cents more. So I'm a bull on uranium. Just never mind the rumors. Focus on the fundamentals. And I do think they will be different for uranium than for other commodities in general. As far as other commodities in general, well, look what Dr. Copper told us in January. Dr. Copper saw the outbreak in China for what it was and fell off a cliff. That didn't seem to spread to the rest of the world so quickly. But I think what happened just Friday, just yesterday, with OPEC and Russia not being able to agree, oil down $10. I want to say 10 cents. It's hard to say $10 in a day. These are big moves. And oil, like Dr. Copper, it's the heartblood of the global economy. So for oil to drop $10 in a day, this is telling us something. And it's not just about, OPEC and Russia couldn't agree. Well, why couldn't they agree? Well, and why are they under pressure? Because the economy is in trouble, because prices are down. This is a big deal. And again, not to sound too fear-mongering, this is the data. This is the trend in front of us. This is the sort of thing I look at. I don't know what's going to happen in 6 months. I do know what happened this week, and it's telling us something. So I don't like making predictions, but I also don't like being wishy-washy. So I'll tell you, this is not my bold prediction for 2020, but I'll tell you that my perception, my take, if you will, is the way the pieces of the puzzle are lining up, the data that I see in front of me. I got to tell you, I'm more inclined towards a 2008 style outcome right now than a 2018. Now, I could be wrong. Maybe the powers that be, the Fed, the ECB, the People's Bank of China, maybe they all just throw caution to the wind, totally open the floodgates on easy money, and maybe they turn this into another 2018 style event. Maybe. I'm not sure it's possible. If it really was a bubble, by definition, once a bubble pops, it's popped. If it just, if it was a hot air balloon with a slight leak, maybe you could patch it. But if it's a bubble, it's gone. I don't know for sure, but just looking at what's happened, the damage, the level of fear, the volatility that we're seeing, the VIX over 50, staying over 30 for a long time. I mean, these are hard things to recover from. So my personal feeling is that I think it's likely that we will see another 2008 style event in the months ahead. Could be wrong. That's my personal take. But whether it is, or whether the powers that be really, like the Powell pivot, pull out the stops and turn this thing around, I don't know. But either way, it's going to be very good for precious metals. Darn it, there I go again. For monetary metals, for gold and silver. So I don't know what's going to happen with copper or oil or any of these other things. I think uranium has the potential to hit it out of the ballpark. That's my high risk, high reward end of my portfolio. The high confidence trade here is just gold and silver. Yes, maybe zinc comes back or maybe palladium, because of the supply crunch, does well. Maybe. I don't know what's going to happen to those things. But everything I see in front of me now tells me to be extremely bullish on gold and silver. And the only reason I'm not buying hand and fist right now is because history tells me that there's more downside likely ahead. So I'm waiting for the safe to be smashed on the street, and I'm willing to miss today's bargains because there'll be plenty of time to make money. Once that safe is smashed on the street, we're looking probably at years of price rises ahead. I don't need to bottom tick this. There's time to make tons of money after the bottom is clearly in. That is my take. Okay, so I've already gone on longer than I intended with my introductory remarks, and I'm really here to help you with your questions as long as my voice holds out. The very first question I got was, what's wrong with the PPSS play Step Gold? It's on the runway. And so I'm sort of glad and unglad that I got this question asked first, but I'm going to answer it first because I did try to warn everybody that I do want to avoid questions about specific companies. So I'm not going to give advice on Step Gold. A person asked this, and I'm not allowed to give individual advice, but also I do have a service for this. It's called My Take, and I give my take on companies. I am allowed, based on the First Amendment, to publish my advice to the broader world. And if you'll forgive me, as G. Gordon Liddy used to say, crass commercial message, I have to say, if ever there was a time where the My Take service was what the doctor ordered, it's right now. A lot of people didn't get My Take. They didn't understand a newsletter that doesn't make stock recommendations, that doesn't say, oh, here's the latest pick. That's not what My Take is about. It is about giving you my take based on my experience, my contacts in the industry, everything that I know. What is up with XYZ company? That's what I cover in My Take. And right now, where people are trying to rationalize their portfolios, they have questions, they're not sure what to hold, what to sell, what to look to buy if it gets cheaper. This is precisely what My Take is designed to deliver. So, end of commercial message. If you've got questions about specific stocks, please subscribe to My Take. I may have covered it already, and if not, I do take requests. Now, I can address the issue, though, the sort of broader issue with this particular play. And there are a couple of things just to remind you of. The pre-production sweet spot does not guarantee success. fully 5% of companies that start to build their mine never actually make it to the finish line. It's more like 8% if you count the ones that are taken over so that they don't themselves finish it. And amongst all of the cases in my data set, about 25% of them had negative outcomes for shareholders. That's even if they did finish the mine that they're building. Pre-production sweet spot, for anybody that doesn't know, please go to the website right at the top in a nutshell. So even if you succeed building your mine, 25% of the time, the outcome was negative for shareholders. So you can't just throw darts at a board. And a good 45% of the time, the outcome was modest. You know, it was positive, wasn't negative, but it wasn't a big win. You know, you might have been better at just putting money in the bank. You know, the good news is that the top 5 performers, you know, the wins are spectacular, 6, 7, 8, 900% gains, which is why the average gain in the pre-production sweet spot is about 100%. So it can deliver in spades. You know, what's wrong with any particular company? Well, that's that's the trick. That's what you need to know. You can't just throw darts at the board here. Due diligence still matters. You need to cover the basics. You need to look at political risk. And I guess I will say in the case that I was asked about, political risk is certainly an issue. You know, people are concerned about investing in Mongolia. You know, no reason for that to go away just because it's a PPSS play. Further than that, I think, you know, if you look at a company's press releases and what's going on and how they're doing in there, it's fairly obvious when there are issues that might cause a PPSS outcome to be less than ideal. But again, there is a detailed free report. If I forgot to mention that before, if you click on that PPSS link at the top of our homepage, there's a great big report with all my latest findings. It's absolutely free. You're welcome to it. And hopefully, you know, hopefully you'll decide to hire me to help you pick the best PPSS place. But if not, you can go it alone. I've given you the core concepts and my latest findings. All right, a longtime reader asked me if I would cover coal and shipping today. So this is probably a rabbit hole that I'm not going to go down too far. I think, you know, these are both issues that are economic barometers. I talked about Dr. Copper. I talked about oil. Coal is like that. Coking coal, it's not an energy mineral the way regular coal, thermal coal is. Thermal coal is the one that most people think of when they say coal. You know, that's down 40% over the last year. It's down 5% just in the last week for the same reasons that everything else is going that we're talking about. So, you know, these commodities are telling us something about the global economy. The shipping, you know, the big number there that made a lot of headlines in 2008, that's the Baltic Dry Index. That has seen some dramatic moves. It was over 2,500 last September. It dropped to below 500 last month. Clearly something, an important indicator there telling us something about the global economy. It's bounced back a little bit right now. It's over 600 as of Friday. Is that a dead cat bounce? I don't know. So without getting too into detail into either one of these, my take right now is I view it very much like oil or other industrial commodities or industrial indicators. Yes, there are bargains there, but I don't want to catch a falling knife. You know, I have no reason to believe that any of these things have bottomed. I have every reason to believe from the data in front of me that things will get worse before they get better. So I'm just not interested in trying to time the bottom here. I want to see it clearly in my rearview mirror before I get into any of these. You know, could coal become so terrifically oversold that it becomes a spectacular contrarian play? Sure. You know, despite the fact that China and many other BRIC countries are trying to build nuclear power plants to get away from coal, they still need it. It's still baseload power in a lot of countries in the world. In some places, there's no other choice. Kosovo is one where they're even getting permission to build new coal-fired power plants. So I'm not quite ready to say coal is dead, but it is that sort of thing. This is an industrial commodity. I see no reason to get into any of these. What would it take for me to put my own money into a coal play? It would take a lot. because you can never be certain. It is subject to regulatory and legislative setbacks. So it's pretty risky. And again, why take a chance? Maybe coal becomes a great contrarian play, but if that's a maybe, and I'm certain that gold and silver are going to, or certain as I can be as a speculator, that gold and silver are going to go up over the next year or two, why take a chance? Maybe diversification, fine. But let me just sum that up by saying, if I go there, it will be because I see something that is so hands down, a terrific speculation. Almost can't go wrong. Yeah, if somebody can persuade me that they've got a deal like that, sure, I'll have a look at it. Not a question, but a comment from people watching live. Doug Casey books, yes. Well, here's his fiction. His nonfiction, of course, I have them display. Notice the subtitle with Louis James. Not to take credit away from my friend and former mentor. These are co-creations of ours. I'm very proud of our work in that, and it was a lot of fun. My own novel is here. Wrote that in 1998. Thank you for noticing. I have a more specific question back on the uranium question on specific effects of the virus on the sector. I think I may have addressed that already. I don't want to repeat myself too much. I do see baseload power as being essential. I mean, you're not going to turn off the lights to hospitals. Maybe you're going to smelt less aluminum or other very energy intensive things. But again, baseload power, I just don't see that fluctuating much. I think the drivers here for uranium have almost nothing to do with the coronavirus. They're about supply and demand. They're about utilities that had built up large inventories, drawing those down. And I just don't see that changing until those buyers are forced back to the negotiation table, which has not happened yet. Now, that's uranium. The uranium stocks are another matter. As we have clearly seen over the last couple of weeks, when the broader markets get smashed, I mean, when you have those 1,000+ point down drops on the Dow, the uranium stocks can get hit. They're still stocks. And if people are forced out on margin or funds are facing redemptions, they're going to sell what they've got to sell. And that can hit everything. Now, the beam of sunshine here, though, is that we did see on some days uranium stocks actually bucking the trend. And even on one of those big $1,000 down days, if you look on our website on the free content, I just did an interview with the CEO of ISO Energy. And that's one of my In the Pit interviews. And that's just a striking story because that stock was actually in the green on that Tuesday where we saw that one of those big $1,000 down days on the Dow. Why? Because of spectacular drill results. So, and on other days, we saw other uranium stocks rising as well. Not quite as much as ISO Energy did based on those drill results. But we did see other stocks bucking the trend. So what I'm saying here is that if we see big 2008 style waterfall events, the uranium stocks are likely to get whacked again. The good news is that it's clear already that investors out there, savvy investors, already know that the uranium stocks are different. The uranium stocks are not like Tesla or whatever else is getting whacked. It's certainly not like the travel industry, the airlines or the restaurants or tourism related businesses that should get whacked in a situation like now. Some investors see that. We saw this in the price action. We have, again, not bold predictions, but we have data in front of us right now telling us that there are people out there who understand that the uranium space is different. So when it turns around, I can't tell you when it's going to be. My sense is probably not right away, possibly this year. I hope it's later this year. I believe that the companies that I have in my portfolio will pull through regardless of what happens this year. But I don't see it going on for longer than about a year at most. And I think there's pretty good odds that, these buyers will be forced back to the table, once their spreadsheets tell them that they've got to do something. All right. So enough about uranium. Just remember, the stocks and the metal are different things, but we've already seen evidence that buyers get that uranium is different from other things. Another question sent in advance was thoughts on biotech. I think this question may have been sent before the markets melted down. So clearly, all stocks are susceptible. The question was not specifically towards, vaccine researchers and so on. So let me break that into two pieces and just say that as a general thought, never mind what's happening right now in the broader markets, but as a general thought, I do like the idea of biotech stocks. They have a tendency to have kind of binary outcomes, rather like an exploration play. When you drill a project, either the gold's there or it's not, or the uranium or the oil or whatever it is. And usually you have a pretty good idea whether your thesis, your geological hypothesis that you're testing, whether it's correct or not. That's very clearly true in the oil patch, particularly. You have a salt dome or something and you drill it, there's nothing there, there's nothing there. And if something starts coming out of your well, yay. Biotech's like that. You get an FDA approval. It's binary. You get it or you don't. And the consequences for the stock can be huge. So on a conceptual level, I really like biotech and other similar areas of technology where patents or approvals or new discoveries can really make all the difference for a stock. My problem with this, though, as a speculator, is that that's not my expertise. It's not, I'm not an expert in biomedical research. So knowing which company is going to have the best CRISPR technology or something, I don't feel qualified to make that decision. So I'd have to subscribe to somebody's newsletter, I think, for ideas. And I'm just a suspicious speculator. I've been burned so many times. It's difficult for me to trust other experts. I understand people who don't trust me. I don't trust experts. The only reason I trust myself is because I have access to the inside of my head. You don't. So thank you, those of you who do trust me, and those of you who don't, no hard feelings. I understand. I'm just like you. Where does that leave me? Where it leaves me is no biotech in the portfolio right now. And what I can say is I could go there, sort of like I said with the coal. For me to go there, I'd have to be convinced that this thing is absolutely the best thing since sliced bread. Like some expert would have to persuade me. And maybe I'm not an expert, but I'm not scientifically ignorant. They'd have to persuade me, and everything they told me would have to be consistent with what I think I know about science. And if all those things aligned, and they convinced me it's going to be a great speculation, maybe. The criteria be very high. So if you ever see me write up a speculation in this space, then you would know that my level of conviction was extremely high. Otherwise, I just wouldn't go there. Sign up to somebody else's biotech letter. Now, about medical researchers in the coronavirus, I suspect that to the degree that it's an issue, it's probably priced in at this point. The panic knee-jerk reaction, everybody would look for those obvious contenders. But even if somebody's researching this, there's no guarantee that they'll find one that's effective. How do you know which company developing which vaccine is going to have the winner? How do you know which one's going to get approved? How do you know which one's not going to have, bad side effects, or that the market won't get bored and forget about this if the virus goes away in the summer and it's going to take a year for this thing to be proved up? So, if somebody has picked the right one and they win on this, kudos to you, congratulations. Not my area. I'm not going to make a call on that. And my feeling is that right now it's probably too late anyway. That's not for me. Okay, I have another company-specific question. I'm not going to mention the company name. Again, if you want my take on specific companies, please subscribe to my take. I've covered almost 200 of them already, and I do take requests. But the specific company is a lower Quebec play and with district potential and so on. And what do I think about that? Well, I think there's actually a lesson in this and something worth discussing with all of you. Obviously, Quebec is a relatively strong pro-mining jurisdiction. Lower Quebec is an area with a vast amount of mining history. You have trained workforces, you have infrastructure, you have a permitting regime and regulators who understand the business Lots of great reasons to look for or to invest in companies working there. But beyond that, as far as the particular equities go, it's like anything. You have to take these on a case-by-case basis. Just because something is in Lower Quebec or Upper Quebec, where, by the way, you have higher tax incentives, these Plan Nord, these sorts of things, there are tax incentives for exploration in Upper Quebec. So I wouldn't just say Lower Quebec is the only place to look, or any pro-mining jurisdiction. If you like the area as a relatively safe place to speculate, great. Then you have to pull out, Doug's 9Ps or my due diligence boots or whatever due diligence you want to apply, and go through everything else. Look at the people, look at management, look at track record, look at skin of the game, look at the growth potential for the company, look at the exploration risks if it's an exploration play. I wrote an article that became somewhat controversial recently called "Exploration is Worthless." And that's not to diss my geologist friends. I love the geological search. But the point of the article was that when it comes to valuing a stock, the exploration is an input. It's not an output. It's not something that's worth anything objectively on a market cap basis. And I would say this about area plays too. An area that has a great endowment and has many other successful companies working there, that's a great place to look. Does it make a stock worth 20 million more than another one that's somewhat outside of that area? No, no, it's not worth anything. Just the fact that you're in Lower Quebec, Upper Quebec, Ontario, whatever, it's not worth anything in market cap. If you had Company A, Company B with the exact same drill results or production profile, or the situation on the ground was exactly the same, I wouldn't pay more just because this one was in Lower Quebec. But the one caveat being, if Company A is in some very risky place in Africa, yes, then I would pay more for the one in Quebec. But we're not talking about that in general. I'm just trying to caution people, because I think it's something that a lot of promoters use. We've got, there's a whole list in that Exploration is Worthless article. I suggest you look it up if you haven't seen it. There's a whole list of things that promoters use for why you should pay more for their stock, or why their stock has to go up. And being in Lower Quebec does not mean that that stock has to go up. So, end of rant. No, no, I don't pay more for land. All right. New question in. What do I think happens to gold stocks when the economy tanks? I think I've probably covered this already, but I guess there is a very specific nuance in terms of lessons from 2008. If you recall, during the waterfall period, the whole 2008 kerfuffle lasted half a year, but the part where it was really bad, just you didn't want to get up in the morning because you didn't want to look at the stock charts. That lasted, basically started in September, but it was really October, November was the worst part, bottomed late November, early December. And it took everything down, even gold itself. And as we've discussed, I have recent articles on this. There's one on Gold's Up, Why Are My Stocks Down? There's other articles on this that you can look at on the website. But when you're faced with an honest to goodness liquidity crunch, when people are being forced out of margin, these redemptions, other things we've been talking, or people are just panicking, they sell everything they can, and they will throw the baby out with the proverbial bathwater. So if we're looking at a 2018 style event this year, probably gold doesn't get whacked too much. We've seen actually gold power on upwards. It's obvious to people what's going on. Fear and monetary policy, and now fiscal policy, I think are very good for gold in a 2018 style scenario. But if it turns into a 2008 style scenario, doesn't matter. People can know that gold is a great thing to own and that gold stocks are great speculations and still be forced out. In fact, I had a phone conversation with a reader who told me that, not this Friday, but the previous Friday, and he's hardcore, as gold bug as I am. He told me he had bought some stocks on margin and he was forced to sell. So this is somebody who gets it. He's completely on the same page that you and I are. and he was still forced to sell. So the answer is everything gets whacked in a 2008 style event. So why not sell everything now? Because I don't know that it's going to be 2008 style event. If it's 2018 and we sell everything now, we'll have to buy back in at higher prices. Now, if you're really worried about it, if you're really convinced that it's a 2008 style outcome in front of us, maybe you do sell. And if like I was saying earlier, you miss some bargains and you have to buy back in at a higher price, maybe it doesn't matter. If you are forced to buy back in at a higher price because gold is taking off, there will still be months, if not years, of money to be made at that point. I hate taking losses, so I'd rather hold on because I have confidence that the stocks in my portfolio are going to come through whatever comes in front of us. But yes, if it's 2008 style, gold and the stocks will get whacked. And my plan, your mileage may vary. You may want to get out of harm's way if you're absolutely convinced 2008 is ahead of you. But my plan is to see what happens, see if it is a 2008 style event, and then look to deploy cash when the safe is firmly embedded in the pavement in front of me. Okay, I have a drill results 101 type question. What are the basics about grams per ton, gold or silver, and so on? This, I could probably write a book about that. I have written an article, though. If you go on the website and you look, it's a free Speculators Digest article. If you look, it was December 17, 2018, or you can try searching for what is high grade. And I discussed distinguishing between, open pit type drill results, underground drill results, gold, silver, copper. I gave some specific ranges in there. The answer is obviously, there isn't one size fits all. You kind of need to know what you're doing, what you're looking for, what type of target it is. But I have a basic primer in that what is high grade essay. So I encourage you to look at that. And then just keep studying and send me more questions. If there are specific questions, I'll do my best to answer them. If they're about specific company drill results, then that would have to be for subscribers. I do take questions like that and answer them in the paid newsletter. In the Independent Speculator, if people don't understand the drill results of one of the companies in their portfolio, I will answer that in the Q&A. And by the way, I've talked about my take a lot. The premium flagship newsletter, of course, is the Independent Speculator. And if you're worried about markets like this, my take will help you rationalize your portfolio. But the Independent Speculator, it's not just a monthly newsletter. It comes with an alert service. I put out four alerts in 1 week when the market's starting melted down. And I've provided, company by company news updates in between. So I'm really there for my readers of the Independent Speculator. And not only is it about where I put my own money, so I have skin in the game, but I'm very concerned about the outcome for all of you. So I'm doing my best to be there as close to 24/7 as I can to take care of you. All right, another question here. This is one of my favorite questions. I have a question here for somebody who's looking for 10 baggers, or maybe even, the proverbial 100 bagger. How do you identify a potential 10 bagger or one of these 100-to-1 stocks, which do happen? I mean, this does happen. And unlike, say, Microsoft or Amazon or some of these tech stocks that have run 100-to-1, which took decades to do it. I'm not trying to claim that only mining stocks can give you a 100 bagger. I am saying that it took decades for a Microsoft, Apple, and Amazon to deliver those kinds of gains. Whereas something like Paladin back in the previous big uranium bull run up to 2007, 2008, that time period, Paladin was a 16,000% winner. I mean, this was a 100 bagger for people who got in under a penny and sold for dollars. But it happened in 1 year. Well, no, I guess if you got in for a penny, it was before 2007. It happened in a couple years, but it wasn't decades. So these things are rare, but when they do happen, and when you're lucky enough to have one, they can be absolutely life-changing events. So that's the good news. The bad news is, hate to rain on your parade. Here I am, the abominable Dr. No again. There is no formula for this. There is no way to predict this. Not even Rick Rule or Doug Casey or the speculators that I admire the most. None of these guys can tell you which stock is going to be the next 100 bagger They don't even pretend to do that. And none of them can tell you which is going to be the next 10 bagger even. It's out of our control. The answer to this is that you embrace a shotgun approach or a basket approach. And the bigger your basket, the wider your shotgun, the better your chances of netting one of these huge wins. Now, the problem with that is that a lot of times people tell me this, that they want a 10 bagger. And my pushback is usually, you probably don't. You really don't. To do this, to have this big basket approach, you need a lot of money, and you need to be willing to take a lot of losses. You need to be willing to take more losses than wins. And people say that. People say, I understand, I'm going to lose money on a lot of these, but my 10 bagger will make up for it. And yes, that can be true. Like if you do the math and you get a 100 bagger in there, yes, you can come out ahead. But my experience, corresponding with hundreds of readers, maybe thousands of readers over the years, been doing this for 15 years now, plus, my experience is that few people really have the intestinal fortitude to see 6, 7, 8 out of 10 of their stocks go down, and not just go down a little, but a lot, and have that 100 bagger amortize the losses, as Rick likes to say. Just most people can't do that. And I think it's important to be honest with yourself. Look yourself in the mirror and ask yourself, could I take not just a loss, but a big loss on 8 out of 10 stocks that I buy, shooting for 10 baggers and 100 baggers? And I simply think the answer for most people is no. If the answer is yes, that's how you do it. And you don't know. There is no formula for doing this. The only real advice I can give you on this that helps tilt the odds in your favor is to skew towards the prospect generators. The prospect generator is an explorer like any other, but they get other people to pay the high risk dollars exploring their early stage prospects. And so that mitigates the risk. I'm not sure that a prospect generator has any better odds of making a discovery than an explorer that spends their own money exploring their own projects. Exploration is still exploration. It's still a bloody difficult business. Under the best of circumstances, the odds of any one company making a discovery are hundreds to one against. The benefit of the prospect generator is that it defrays that risk by putting other people's money to work. And a prospect generator can go years without raising more money. They can keep a nice tight share structure, spending other people's money, so that even if they end up with 25, 30% of a discovery that eventually gets made by the partner, they do that with very little or no dilution for shareholders. And 25, 30% of a world-class discovery is a lot of value. And that prospect generator can see its shares go through the roof. Some of my biggest wins back in my Casey days were like this. AUEX Ventures would be one of those, where the partner spent the money and eventually proved it up, got taken over by, AUX got taken over by the partner got taken over by Newmont. And as I recall, by the end of the day, that was something like a 1,500% win. So look for people that are putting other people's money to work on your behalf to mitigate those risks. But even with that, if you're going to swing for the bleachers, if you're going to build a swing for the bleachers portfolio, you must understand that you will be taking more losses than gains. You will lose on most of your investments. I have to be frank with you right now, in my own portfolio, I'm not doing that. I do have a new feature in the independent speculator. I call it the buy if you dare list, and there is a list of more high risk, high reward speculations in there. But that's not my portfolio. Right now, my goal is actually something quite different from what I did in the past, in my past employment. And that is, I'm actually trying to win most of the time. I'm accepting that I'm going to have fewer 10 baggers and 100 baggers in there. I'm not swinging for the bleachers every time. My current portfolio consists of pre-production sweet spot plays, exploration that has success in progress, and other companies that I think have good odds, not just long odds, but better than others, but actually better than 50% chance, good odds on actually delivering added value here. And I'm okay with just doubling or tripling my money on stocks like that instead of swinging for the bleachers all the time. So that's my own personal approach right now. Perhaps after I've built up my track record for a few more years and I can afford to take more risks, I'll put more money into the buy if you dare list that I'm developing now. But that's my take on this. And I cannot stress enough, if you're gonna swing for the bleachers, you must honestly be willing to accept more losses than wins. And there is no formula. Nobody can predict those 100 baggers. I don't think anybody can predict the 10 baggers. You just get lucky with the basket approach. All righty. Somebody asked about why PDAC numbers were down from last year. I think the PDAC guys themselves, I believe it was INN, interviewed somebody from PDAC, and they were candid, saying that numbers were down from last year. Still a big conference. I don't think there's a whole lot to say on this. I didn't go. I have somebody who seems to catch bugs very easily in my household, and even if I think I could survive a flu, I just didn't see a reason to bring that home, so I didn't go. And I can do my in the pit interviews online, so it just wasn't necessary. Why take the risk? I'm not sure what else to go with that, other than that PDAC is still, the premier mining conference of its type. That was the first time I've ever missed it in my entire career, and I sure hope to be back next year. I wouldn't mind if the association, the Prospectors and Developers Association of Canada, decided to move PDAC from the traditional March timing to May, June. Summer in Toronto is much nicer in the summer. But PDAC is still a great thing. I wish I'd been there. I'm sorry I wasn't. No need to panic. I don't think I was panicking. I just had a specific reason for not wanting to bring any possible bugs home. Even the regular PDAC flu, I didn't want to bring it home. Okay, another question on explorers during the downturn mode. I think I've answered this already. Maybe not specifically to explorers. I think anything that was deemed very high risk is going to take it on the chin disproportionately, and exploration is viewed as higher risk, but not all exploration. There is certainly explorers. This is what I call exploration success in progress. I capitalized that, SIP, success in progress. And as I said, right now, at my stage in my business where I'm trying to build the business, I'm not trying to swing for the bleachers all the time. I understand that I'm giving up bigger, earlier stage gains. But basically, I have very little pre-discovery exploration in my portfolio right now in the independent speculator, because I'm really trying to bet on things that I think have high odds of delivering. And so interestingly enough, many of these stocks did get whacked over the last couple of weeks, but not so hard. I mean, not as hard as some. It's variable. Some still did, but some companies that are clearly bringing home the bacon. I mean, you can see it. Every press release adds value. The drill results are there, or the deposit's getting bigger. An expanded resource estimate, or metallurgy, or a new feasibility study that clearly shows more added value. Even though this is still exploration, it's not early stage exploration, and a lot of these stocks have held on better than others. But the bottom line here is what I had said before. Pretty much everything, if we are in for a 2008 style event, everything will get whacked. So you want to hold on to things that you think have the right stuff to make it through an event like that. If you're convinced that it's going to be 2018 style, maybe you start buying the dip, whenever it looks like things are turning around on the scary headline front. But please don't write off the possibility of a 2008 style event. All right, I have a question here specifically about silver and China. Chinese losing their jobs, silver for income. Yeah, the question is about whether or not Chinese who have been ordered to stay home and they're losing their jobs, or the money to pay them to stay home runs out. By the way, I have heard that there has been some money even in China for people staying home, as un-Chinese as that may seem. Everybody realizes this is an emergency. and the central authorities certainly want to avoid as much economic knock-on effects as possible. So you got a lot of state-owned enterprises, and they're certainly going to do whatever Beijing tells them. I don't see this as a silver-specific question. If I'm a Chinese person forced to liquidate savings in order to eat, then gold, silver, it's the same. I don't see it as being one or the other. I see it as fitting the overall theme of, in an emergency, people can be forced to sell assets, whether they want to or not. I think this affects both of them. I think to the degree that we've seen silver underperform gold in the recent volatility, it's very much been because silver is also an industrial metal. I don't think it's this, people selling silver more than gold idea. Could be wrong. That's my take. But there is a silver lining there. Forgive me for saying that. To the degree that silver does get whacked harder than gold in either the bottom of a 2018 style event or a 2008 style bigger waterfall event, that just creates a bigger opportunity. I may be wrong. I do not predict the future, but personally, I have absolutely no doubt that silver will track gold. The silver and gold ratio may expand further in the months ahead, especially in a 2008 style event. But if it does, that just adds to the tension on the spring there. And when silver comes zooming back, it'll zoom all the faster and higher. I mean, when silver gets on a tear and just starts catching up with gold, there's no stopping it. It's amazing. And you can look at the silver articles that I've published for free on the Speculators Digest side of the website. You look at the historical charts. Silver always lags gold in a bull market, and it always catches up, and it always outperforms gold peak to peak. Maybe not at the end of the bull run, but when silver peaks on a percentage gain basis, it's a higher percentage gain than gold from bottom to top. So I'm very keen on silver. I've said this, I think, many times in recent alerts and free materials too, digest posts. I like gold and silver going forward. If I have a choice, one silver, one's gold, I'll go with the silver one first. I absolutely, when I'm buying, my top priority is loading up on the best silver stocks I can find. Unfortunately, great silver stocks are few and far between, and many great silver companies have become gold companies. It's just hard to find great silver primary assets. But if you can find them, if you can find a company or great, whether it's exploration or production, that has that silver primary mantra, and it's got what it takes to pull through whatever turmoil lies ahead, that is definitely something to look for. It's absolutely my top priority right now. Okay. I have a question here about shares issued and outstanding. And it's often discussed about how you want to have a small number of shares issued and outstanding. And that's certainly something that I adhere to. Now, I have to say that Australian companies, for historical reasons I'm not sure I entirely understand, Australian stocks typically have far large numbers of shares issued and outstanding. They may come to market with 100 million shares issued and outstanding already. And you can have exploration companies with 500 million shares issued and outstanding, or close to 1 billion shares, as they're approaching production. And it's just an Australian thing. So you keep that in mind. You in Canada, if you had an exploration company with 500 million shares issued and outstanding, that would be a huge red flag. Now, so treat an Aussie share a little bit different, and what you're looking for is the ability of the price to go up. If you've got 500 million shares outstanding, then I want a much cheaper share price. If you've got 500 million shares outstanding and the stock's trading at $10, it's hard for that stock to move up. If you've got 500 million shares outstanding and the stock's trading at 10 cents, it's much easier for that stock to move up. That's in Australia. In most of the rest of the world, 500 million shares, well, you better be a profitable producer and you better not be issuing more shares or there's a problem. An exploration company really shouldn't have more than, it should be tens of millions, no more. As you become an advanced explorer, perhaps you had to issue shares to buy an asset, you may have 100 million. Plus 100 million shares, you're probably looking at very advanced exploration or a producer. Otherwise, there's a red flag. And the reasons for this is two. One is if you have a lot of shares issued and outstanding, you have to wonder, how do they get that way? If it's an explorer that doesn't even have a flagship project yet, and they've got 250 million shares issued and outstanding, what happened? They must have raised a bunch of money, spent it on a bunch of projects that didn't work out. That happens sometimes. Mother Nature can be very contrary. She doesn't seem to love geologists overall. But still, it is what it is. It can also be, a case of management issuing themselves an egregious amount of penny stocks up front and a bunch of super duper cheap options that they exercised. You need to look into the history of the company and try to understand, why does this company have a lot of shares issued and outstanding. The other problem with it is that, if you see an addition of value, if there's a takeover event or there's a discovery, or a new resource estimate that substantially increases the amount of gold or silver in the ground, then the value added is divided amongst all the owners of the company, all the shareholders. And so it's divided by the number of shares. The more shares you have, the more diluted that value added is amongst the shareholders. So it's harder to see the share price go up the larger the number of shares issued and outstanding. And as a speculator, I'm not in this for the dividends. I want to see capital gains. And so a big number of shares issued and outstanding can make it more difficult to see greater capital gains. It's also a red flag as to, how did we get all these shares issued and outstanding. One more thing on this to watch out for is companies that have issued a lot of paper. They know this. They know it's hard to raise money when you're a penny stock with hundreds of millions of shares out. So they will often do a share consolidation, rolling back the share price. So if you see a company that has an advanced asset or has been around for a long time and it has a very low share count, you want to look and see if there's a rollback consolidation in the relatively recent past. If there is, that's not necessarily the kiss of death. You're better off buying the stock after the rollback than before, but there is a risk there from people who got rolled back, and now it's going to be very difficult for them to win. If there's a lot of shareholders that have rolled back shares, and they may just sell on news. So you could see a lot of selling from those pre-rollback shareholders selling into news. After a while, that gets shaken out, and the new share structure is what you have to deal with going forward. Bottom lines is a blown out share structure is a red flag, both in terms of history, how did it get that way, what did we get for that dilution, and in terms of it potentially limiting the capital gains in a stock. All righty. We've been doing this for an hour. When we publish this, I will put timestamps on here so nobody has to watch this for hours. My voice hasn't quite given out yet, so I'll keep going. And I just pushed the wrong button. So give me a second here so I can look for the next question from the audience. Ooh, tons of questions. All right. Oh, dozens and dozens of questions. I will stick here as long as my voice hangs out. But let me go ahead and say this. I'm not going to be able to answer all these questions. And I think what I'll do is I'll start. I have been answering questions from readers in my paid publications only. And what I think I'll start doing is I'll start doing a Q&A section in the weekly free digest. I won't be able to answer hundreds of questions, obviously, but if they're particularly pertinent ones or questions that a lot of you have asked, then obviously that's something on people's minds. And so I'm just, my new gift to you today for everybody, whether you're a paid subscriber or not, is I'll try to take up a Q&A in the free letter. And I'm not going to talk about specific companies. I'm not going to talk about the things that my paid subscribers pay me for. But if there are general issues of the sorts that we discuss in the Speculators Digest anyway, I will take up questions there. Okay, so back to your questions now. Not so much a question. Somebody's telling me that what's happening now is new. Financialized capitalism. Okay, yeah, there's a case to be made that what's happening now is new. There's certainly a case to be made that the financial bubble that we've seen is perhaps the biggest in history. The reason why I've said that several times recently in writing is that, okay, in nominal terms, trillions of dollars and other currency units out there, clearly you measure it that way. But who knows what, in real terms, hyperinflationary situations during the collapse of Rome were like. Maybe it was just as bad in real terms for the people on the ground at the time. I don't know. I don't want to say that this is the worst thing that has ever happened in all of history, but it's clearly up there. I mean, the exposure and the potential for mayhem here. Again, not to be too fear-mongering, I'm not predicting Doug Casey's greater depression, but I do think that card is in the deck. If the global economy was already weak, and whether or not the coronavirus is no worse than the ordinary flu, but it pushes the global economy, rightly or wrongly, into a recession, and it was too fragile to handle that stress, we could see things that many of us thought would happen as a result of the crash of 2008. That could happen now. We could enter a whole new swath of unprecedented, uncharted government reactions, central bank shenanigans. Who knows? I don't know what's going to happen. If you're going to ask me to pull out my crystal ball and predict, I'm not going to do that. What I am willing to say is that card is in the deck. Who knows when it turns up? Maybe it doesn't. Maybe the powers that be push it off. But if you're looking for me to say that yes, things could get really bad, then yes, I'm saying that. Things could get really, really bad. Do prepare for the worst and hope for the best. I think I've answered a number of these of when to buy. I have a question here about the electric vehicle issue and what I call the new energy paradigm. That's a broad issue that I think is certainly worth taking up. I have written about this, and as far as the overall story goes, I do still see that as a paradigm shift. It's not just about Tesla anymore. All these people, this is one of those things, like if I write about the economic impact of the coronavirus, people want to write in and argue with me about the medical facts. I'm not a doctor. I don't want to argue about the medical facts. I'm talking about the economics. Same thing with this EV thing. Every time I write about it, people are saying, Tesla's going to zero, or Tesla's going to 10,000. I'm not talking about Tesla. It's not about Tesla. It's about, in my view, the writing very clearly being on the wall. It's not just about government subsidies anymore. The consumer wants electric cars, and they want to see the world stop burning petroleum for energy. Rightly or wrongly, I'm not saying I agree with Greta Thunberg or whatever. I'm just saying that's the trend that's in front of us. My job as a speculator is to look at what's happening, and what's happening is it's not just governments anymore. Consumers want these products. And it's not just Tesla, the Porsche Taycan. You've got major automakers that are just wholesale converting over their lines to electric vehicles. This is happening. So there are minerals that will be necessary for that to happen. Now, can the coronavirus and possibly a global recession slow this? Sure, it can. It almost certainly will slow it, but the trend is still happening. Auto sales may go down for years. I mean, the Chinese figure is mind-boggling. There was more than 90% decrease of auto sales last month, or the last reported month. I mean, it's mind-boggling. So clearly, yes, we can see auto sales decreased, and yes, that's going to have an impact in the short term on the demand for the components of the electric vehicles. But it's not going to change the trend. Nobody's saying, coronavirus, let's forget about electric vehicles. Let's go back and just produce gasoline or diesel-powered cars forever. That's not happening. So whatever happens in front of us, whether the coronavirus gets much worse or it all blows over, whether the global economy goes into a recession or whether the powers that be make it better with more easy money, whatever happens, I think the transition, the paradigm shift is happening. I think it's one way, and I will be extremely bullish on not all the components, but the ones that are in short supply. My favorites in this space are definitely nickel. I'm on the fence on cobalt. Supply issues there. But nickel definitely, copper definitely, not lithium, not graphite. And we'll have to see. I mean, when it starts happening, I need to update my models because I've been so concerned about this really for more than a year now. I have not updated my models, so I can't say which specific metals beyond this. But I'm when the time comes, I'm very bullish on copper and nickel, no doubt. The others, I'll have to look at that time. So this is just one of those things. I'm no interest whatsoever in trying to get in front of the potential harm that's in front of us right now. I will wait for the crash, go to cash, wait for the smash, and see what we can do then. Can I quickly recap the difference between 2008 and 2018? Well, I hate to say it because the difference, well, there are a lot of differences, and the causes are, the immediate causes in front of us are different. Clearly, the coronavirus thing is different right now. The degree to which people were out on margin then and now, I think is different. The derivatives, the whole derivative universe, I think is structurally somewhat different, though again, really blown out again. But I think the biggest difference is that in 2008, the powers that be really had no idea. They had no freaking clue what they were in for. And even mid-2008, Bernanke was still out there saying everything's fine, and we've got the tools, it's going to blow over. And then when it hit, he's out there saying nobody could have seen this coming, even though we at Casey Research, Peter Schiff, other people were ringing the alarm bells loud and clear. Some of us knew that this was coming, not when, but it was clearly in the cards. But the establishment didn't get it. The establishment didn't believe it was possible. The establishment reacted after the fact and slowly, and we got 2008. And at this time, that's not the case. 2008 is recent memory. 2008, I mean, heck, we had this emergency 50 basis point cut by the Fed. So clearly they're paying much more attention this time. Powell is not out there saying there's no chance, there's nothing to worry about. He's out there saying, we're fine, but we're worried about these other things. But at least he's worried about something. So I think the powers that be will react much more quickly, much more strongly. I confess it's difficult for me to see them staving off all the bad news I see still getting worse in front of us. But I was wrong about that before. So maybe this will be another 2018. But that's the difference. I think, well, that's an important difference, is that the powers that be are there, and I think they have their hands on the buttons, and they're ready to mash those as soon as they get worried enough. Now, there's another important difference, though, not so much about what's going to happen with the economy or the world or whatever, but I think there's a very important difference for gold and silver, the monetary metals. And that is when 2008 happened, there was a whole generation in finance who had never seen gold really do anything more than gather dust. The barbarous relic criticism was accepted. It was conventional wisdom. And the old, gold doesn't pay interest thing was not just conventional wisdom. That was like the sun comes up in the morning. It's how the universe worked. Everybody knew these things. And then 2008 happened, and everybody saw, all these traders who wouldn't have touched gold with a 10-foot pole. They saw gold come screaming back from one of the sharpest V-shaped bottoms ever. In December 2008, they saw gold end 2008 up while everything else was down. And the broader markets had a long, painful U shape, but gold had a terrific 2009, 2010, on up into 2011. Everybody knows this now. And now, 10 years later, you look at mainstream finance and people talk about gold. Nobody talked about gold before the crash of 2008. And even when it happened, nobody cared about gold. It was this barbarous relic. It didn't matter. It was history. And now you see mainstream financial outlets, like these guys on these millennials on Yahoo Finance. I love watching Yahoo Finance because you have all these young guys on there. And they love the FANG stocks, and they're always looking for the latest startup, and they have people in. And sometimes they have mainstream guys from the old Wall Street establishment on. And you hear these guys talking about gold, even silver sometimes. Jared Blickery, their technical guy, pulls up the Yahoo Finance interactive board, this giant screen where he pushes all these things and pulls up charts. And they talk about gold. They talk about it every day. They talk about how it's doing, and they talk about it as a safety factor. This is, in my mind, absolutely 180 degrees difference between 2008 and 2020 now. But it is a difference in terms of outcomes. I think this is very important going forwards. If we're in for a 2008 style event, we get a crunch, people will sell what they have to. Even gold and silver will sell off, not because people want to, but because they have to. But in a world now where an entire generation that was ignorant of gold before is now well aware for it, even if disdainful, they're aware of it. I think we have potential for a much quicker and much more violent reaction to the upside when things turn around. Okay, my voice hasn't given out yet, so let me take another. This is a good sort of fundamental question. It's the skin in the game question. This reader has read that juniors should have at least 10% insider ownership, that more is better. How important is this? Well, clearly it's very important to me. I've built my entire business of the Independent Speculator, my flagship newsletter, about it. It's not just that I disclose whether I've invested in the stocks I write about or not. The whole idea of the newsletter is that it's the list of stocks that I put my own money into. I just don't see why you would listen to somebody who isn't willing to put their money where their mouth is. And the exact same logic applies to the company. Why would I listen to a CEO who's telling me I should buy a stock if he's not willing to put his own money into the stock? And I don't mean he got cheap options and he was given stock to come on board. I mean, he put cash, his own cash, into it. And in every single one of my in the pit interviews, I will ask the CEO or whoever I'm speaking to, did you put your own money into it? And I've perhaps been too nice. If he hadn't put much in it, I haven't jumped up and yelled at him or anything. I'm trusting you to be smart enough to notice if the guy says, oh, well, I'm not a rich man, I don't have much money to put in there. Well, that still tells me something. As far as a specific number, no, I wouldn't. I don't use a 10% litmus test. If I know, for example, that the CEO was a geologist who just started this company, and that he didn't have a lot of money, and he only put 50 grand in or something, but that was a lot for him. Like, that was all of his savings. That would mean a lot to me, even if his 50 grand was nothing compared to the overall startup position he's in for 1% or something. If that was a meaningful risk on his part to put his savings into the company, that would matter to me. So rather than a percentage, I would talk to management, and I would need to be convinced that they have enough skin in the game to matter to them. And I think this it gets lost a little bit in the majors. I think it's absolutely crucial in the juniors. I think it's less in the majors, but I don't own a lot of the majors. But the majors, you've got a lot of other metrics. You've got growth on tap, and if the company has grown so big, it's hard for management to maintain. I wouldn't expect the CEO of Barrick to own 20% of the stock. That would be very difficult to do. So it is a bit different for the majors. But I would like to see that management still has significant skin in the game. Significant for them, right? It's hard for them to have a big percentage, but I would want to know that that it matters to them whether the share price goes up or down or not, and not just because of free options. But they put their own money where their mouth is. All right, another fundamental question here is prospect generators. I've talked about this already, but the specific question about how many of them have royalties or are accumulating royalties. And so let me go two ways with this. One is I've already talked about how I like the prospect generator business model. If I am going to swing for the bleachers, if I want to speculate on pre-discovery exploration, absolutely no question that prospect generators are the best way to go on that front. But unless the royalty is on a producing asset, and very few of them have this, it really doesn't matter. It's it's potentially a benefit down the road if it's the type of royalty that they could now sell off to this emerging crop of new royalty companies. That's cool. I would look at that royalty as being more like cash in the bank or securities that they have. A lot of these prospect generators, they get a whack of shares in their JV partners over the deals. And as the deals change or they get new partners, they hold all those shares. So a lot of these, they'll have cash, they'll have royalties, and they'll have shares in their former partners that they can liquidate. So I look at all of those as being insurance against dilution in the prospect generator, and I do like them on that basis. But unless somebody's building the mine that the prospect generator has a royalty on, or it's already in production, it's really not going to do much for mitigating the risk or the expense now. That said, let's segue from there into royalty companies. I like the royalty company space. I see it as sort of an intermediate space. It's a thing of beauty that you can get paid and profit from rising commodity prices in metals and mining space, which is so risky a business, without actually being in the business of metals and mining yourself. Because of this, I wouldn't expect your Franco-Nevadas of the world or Royal Golds of the world to have the kind of upside as, say, a major producer that was marginal. If a major producer was making $100 an ounce mining gold and selling it, and gold goes up $500 an ounce, well, suddenly he's making $600 an ounce. That's huge, and the share price should reflect that. But if you're a royalty company and gold goes up, then your marginal impact is different. And so what I'm saying is it's safer, but I see less potential alpha there, less potential upside. So it's just a risk-reward question for everybody. I'm not poo-pooing the royalties at all. I like royalties. In fact, in the same way I said, the independent speculator portfolio is the portfolio of my own personal investments today. That's what the core of the newsletter is. I also, because some people do, and readers ask me for swing for the bleachers type opportunities, I created a shopping list, the buy if you dare list, with more of those types of investments. I also have something that I call the go-to list, because I also have readers that they like the bigger companies. They like the lower risk plays, like some of the royalties and the producers. And so I have now an additional alternative portfolio called the go-to list. And that's where this type of company goes. In my mind, the better ones, they're just no-brainers. It combines a perfect world, as you were, of leverage to the underlying commodity. It's better than just buying gold and silver itself, or whatever the commodity is. Other commodities have royalty plays on them. It's better than just buying the metal itself in terms of leverage to the upside, but it's nowhere near as risky as buying into a producer, which even the best producers could run into force majeure issues that take them down. Mining is a difficult, risky business, and royalty plays are absolutely, no question, the best way to mitigate against that risk. Okay, another question I have here is sort of a positioning and portfolio allocation or size. And this is a basic speculator 101 question, so I do want to address it, but it's very much a one size doesn't fit all. And my questioner recognizes that. He says, I understand that, it's not the same for everybody. So here's the way I summarize this. Absolutely do not want to put all your eggs in one basket or one or two baskets. Speculation, even with the best trade, the highest, the royalty company that you like the most, say, a safest combination of leverage and upside. Well, they could get hit with a tax assessment by Revenue Canada or something out of left field can just come and whack the stock. So you must not, no speculator can afford to have just one or two positions they're in love with, just way too risky. You want a basket approach. Now, whether it's a swing for the bleachers, buy a few dare type basket, or whether it's a go-to type basket, or whether it's my balance of trying to minimize risk and maximizing gains that I have in the independent speculator portfolio, you want a basket. Now, how to allocate, how much to put in there. It's bad enough if you speculate and you can lose money on getting a bad speculation. As bad as that is, we're all grown-ups here. We're big boys and girls. We know that we can lose money. We're speculators, right? We get that. But the most painful thing, and I feel this myself, is when you get something right. You do the due diligence, you take the risk, and you get something right. But you didn't have a lot of money at the time. You only put a couple $100 in it or something, and it's a 10-bagger. And now your $100 is $1,000. Well, that's great, but $1,000 for most people is not going to change their life. So the balance here is that you want a basket, but you want to put enough money into the various positions that it matters to you if it wins. Now, if you're multi-millionaire, you're probably dealing with tens of thousands or hundreds of thousands of dollars in various positions, maybe $1 million in a high conviction trade, because you can afford it. And it takes an investment that big to really matter to you if you get a 10-bagger. But the same logic applies if you only have a few tens of thousands of dollars. You don't want to put a couple $100 into 100 different positions. You do that big shotgun approach and you get your 10-bagger or 20-bagger, and it covers your mortgage for a month. How disappointing would that be? You want to have positions big enough where that if they go up 5 times, 10 times, 20, whatever, that would be a win to celebrate. And again, you don't want to spread yourself too thin. The rule of thumb I've had on this is that if you get a press release from a company that you're invested in, and it mentions results from a project or a property, and you don't recognize the name, like, oh, we had 10 grams per ton over 5 meters on the XYZ moose pasture project, and you say, moose pasture project, I don't remember that. Well, you probably have too many stocks. You should understand the companies you're speculating on. And if you have more stocks than you can keep up with, maybe not an in-depth understanding, maybe you don't know whether that drill intercept was great or bad for that particular deposit type, fine, ask me, I'll help you out. But at least you recognize, what they're doing, and they had drill results from this project they were drilling. You should be conversant with the story. You should not be speculating on more stocks than you can be conversant with. The bigger your basket, the more chances of getting the big baggers in there. That's great, but also the more diluted your investments are. So that's the push and tug here. I can't give you any one right answer, but you need to look at your own finances. You want to invest enough in a basket. You want to invest enough that winning big matters big to you, and you don't want to spread yourself too thin that you can't keep up with the stories. I've taken some flack before from people, if you're just starting out and you don't have a few $1,000s to invest, why not invest your $100 here and there? Speculation is hard. It's hard to do well. and it's hard to get right out of the gate. Maybe in a raging bull where all tides are, the tide is lifting all ships, maybe that could work. But in a volatile time like we are now, where it's easy to get hurt, I just wouldn't go there. I would save. I would, skip on some movies. Maybe tighten my belt a little bit in any number of ways. I think anybody who is seriously thinking about speculating should be able to save up a few $1,000s to where you can put at least $1,000 or two into, the various positions you're thinking of. And if $1,000 is a lot of money to you, and you get a 10-bagger, well, then $10,000 is a meaningful win, and it gives you the money to then go and put into other positions. If you can't do that, you probably just wait. Just work, save, accumulate, startup nest egg. Probably you don't want to start with less than 5 or 10 grand if you're just beginning. Otherwise, you take a lot of risk, and you could have that greatest of pains of getting a fantastic win and not having an amount to enough money to really matter. Okay, we're going on 1 hour and 40 minutes here. My voice isn't done yet, but I think I'm going to have to wind up here, take a few more questions. All right, somebody asked specifically about the $50 to $60 swing in gold we saw the last couple of weeks. I think this is an invitation here to get into some areas that some people might think of as conspiracy areas. And this is one of those things where I'm kind of damned if I do and damned if I don't, whatever I say about this. For the record, yes, I do think that there is market manipulation in this space. I think that there are people who will dump a bunch of gold, hoping to push the price down, perhaps in order to buy or in order to achieve some other effect. Now, is this the central banks, and are they all planning and trying to suppress the price of gold? Maybe. As a libertarian skeptic of things governmental, that makes sense to me. Is there proof that the governments are behind this? No, I wouldn't go that far. I'm sorry, I wouldn't go that far. Not saying it's not true. I'm saying I'm not convinced that it's proven. I am also saying that it's not necessary for that to explain what's going on. There are other actors, the bullion banks as they are known, or other agencies that could have any number of reasons for wanting to push the price of gold around. And that happens. And it is part of the reality. Now, do I like it? No. Does it make me throw up my hands in disgust and give up on gold? No. My answer to this is, whatever level of manipulation there is, whatever level you believe in, these manipulators out there, they didn't stop gold from going from $250 an ounce almost 20 years ago up to almost $2,000 an ounce in 2011. Maybe it would have gone higher, maybe woulda, coulda, shoulda been better. Doesn't matter. It went up. So my contention here is, without wanting to get into a religious fight about what manipulation is going on here, my premise is that whatever manipulation there is, it can't stop the fundamentals at the end of the day. It can influence, it can push things around at the margin. $50, $60 swings in gold last week did not stop gold from getting back up to $16.90 again just Friday. It didn't hold that to the close. But we saw a new 7-year high, almost 8-year high in gold Friday, despite whatever manipulation is going on there. So at the end of the day, reality matters. At the end of the day, fundamentals matter. At the end of the day, I'm not going to let whatever concerns I have about curiously unexplained movements in gold prices keep me out of this market. I've made a lot of money in this market, and I wouldn't have made it if I waited for GATA to convince the governments to stop interfering or whatever I'm waiting for. I'm not going to wait. And if we're just going to complain about how much better things could be without the manipulation, I just don't see any value in that. I mean, it's there. It is what it is. I'm dealing with the trends in front of me, and my experience is that I can make money in this market, manipulated or not. So I don't feel any particular need to explain a $50 to $60 move one day last week or not. It could be many things. The fundamentals tell me I'm in the right place. Could I be wrong? Yes, but I am putting my own hard-earned money to work here, in this space. All right. There are several questions about the ETFs, and this is a big can of worms, and not just the gold ETFs, but ETFs in general, passive investing. There's a lot of directions we can go with this. So, maybe that's a subject for a whole webinar on its own. So let me just touch on a few key points. One is that the ETFs have become major buyers and sellers in the physical market, and they have become a sort of a swing trade that can add momentum. So while the original GLD was sort of designed to take gold mainstream, make it easier for everybody to invest in and trade in gold in and out, and I think it has done that. There have been times where I thought gold was overbought or oversold, and traded the ETF just as a short-term, like day trade almost. So that's a good thing. The bad thing though is that when they have to liquidate or when they're buying, they're really adding. They're adding a whole bunch of momentum going in or out to whatever the fundamentals dictate at the time. So it might be that despite all good intentions, that they're making the market more volatile, and that is something to watch out for. It is what it is. We're not going to be able to change it. I just think it's a factor to bear in mind. And I guess if there's a takeaway from that is, if you see anything, it doesn't have to even just be the gold, but if you see something that has a related ETF, just get crushingly oversold or overbought, like out of all proportion to the underlying fundamentals, that I think the ETFs can be seen as a leading cause. I don't know as much we can do about it. It's just we have to deal with a world in which we have increased momentum and volatility along these lines. I have a follow-up question on the royalty companies. Are the junior royalty companies risky? You betcha. There's no question in my mind. I don't want to name specific names, but yes, the little ones come with a great deal more risk. You'll have often just like one or two key royalties in the portfolio. And if something happens to that mine, again, it could be with a great company, but they could deal with force majeure, or something could happen that has a substantial impact and a much larger impact on the junior royalty company than on the majors in this space. So if I'm worried about risk, there's no question, where I'm going in that space. On the other hand, risk and reward. So if I'm looking for capital gains, clearly the little up and coming guys can add a lot more, a lot quicker. We've seen this. I don't need to name names. The obvious contenders out there. Just look at their stock charts until the recent market meltdown, and the percentage gains there on some of these are really quite spectacular. So. Buy if you dare. It's one of those things where it's your own risk reward profile here, what you're comfortable with. Oof. Okay. Vanadium. I'm a little surprised to get this question. But yes, vanadium was a flavor of the day. I gotta say, I warned about this back in 2018 when vanadium prices were spiking. I warned that this was a commodity with a history of spiking and then pulling back. A lot of the related stocks, they really had a moment of joy in the sun, and there were multiple bagger winners in there. But I warned that this was prone to correction. It was, and that's happened with a vengeance. Some of the vanadium plays have pivoted to other metals. One in particular has pivoted to silver. So. Long story short, though, is that there was a reason for the vanadium spike, and that reason is real. It was a change in standards in China that would materially impact vanadium consumption. Now, there's been problems with enforcement of that new standard in China, so it remains to be seen how that settles out. But I think at the end of the day, that will settle out to probably a lasting higher vanadium price, not terrifically higher, but higher. And vanadium could become an important byproduct of uranium mines again, or for very, very high grade vanadium deposits, it could actually make for profitable vanadium mining. But that stable higher price has yet to be achieved. So I'm not interested in any vanadium plays right now at all. The questioner asks about the vanadium batteries. And this is something that I do think is quite interesting. Without getting too technical here or going on too long, because we're going on almost 2 hours now, vanadium works out to be, or happens to be, well suited for these very large industrial scale batteries, the kind of battery farm that you could store energy for an entire town on. And unlike the lithium batteries, they don't overheat. They last for decades. It's a very, as I understand it, not being an engineer, the vanadium flow batteries are a very good solution for large-scale power storage solutions. That didn't matter before because this is new, by the way. This technology goes back to the 60s, and it didn't matter before because we had stable baseload power for just about everything. But now, with the massive increase in renewables, all these windmills and solar farms and so on, you need big batteries to make those things more useful. And so I do see this as a paradigm shift, another paradigm shift that's happening, that large scale, industrial scale, urban scale electrical storage is a wave of the future. And vanadium, I think, is part of that. Now, it's not the only solution. I've heard of iron sulfur batteries. I've heard of other large scale industrial batteries that might do just as well. I think, I slightly I am getting tired. I slightly favor the vanadium batteries in this space because it is a longer, tried, tested, true technology. It's off-the-shelf technology. We know this works. We know how to do it. Could newer battery designs be cheaper? Yeah, but there's more testing to be done. And at the end of the day, I don't think the cost of the vanadium in the battery is really all that material to it. It's not a big deal. You could have vanadium prices double, and it would be a marginal impact on the overall cost of these large batteries. So I do think that gives vanadium a leg up. And I was kind of excited about this a couple of years ago when it looked like this was starting to happen. A big pilot project was installed somewhere in China, I think. But that hasn't really taken off yet. So I like the vanadium story on this front, but success in progress. I don't want to buy into a science project. I don't want to get in because vanadium might be the next big thing in large scale storage. I want to see it happening. And when it is happening, okay, I'll miss the early gains, but I won't have any risk of having jumped on the wrong ship. What if the market does take a turn? What if, it ends up going VHS instead of Betamax? Maybe vanadium batteries are better, but something else turns out to be the one that catches on. I don't know how this is going to come out. And there is risk in assuming that large-scale adoption of vanadium batteries is going to boost the vanadium price. So I'm not interested in getting in front of that. When it's happening, plenty of time to profit at that time. All right, I have a question here about warrants. I'm not sure I understand the question entirely. Maybe it's about private placements, or warrants. Actually, I remember there was a fund that was specialized on just warrants. Some warrants are tradable. Some warrants you get when you participate in a private placement, and it's non-transferable. It's your option if the share price goes up to exercise your warrant and buy in the future. But some warrants last for many years, and they become tradable. And there are secondary listings, not just for the stock of the company that has these things, but for the warrant itself. And it can be a very interesting way to speculate on a company because the warrants are obviously going to be at a discount to the share price. On the other hand, the warrants are typically out of the money. So you have to wait for the warrant to be right. It is not a free option. It is an option. So it mitigates risk by buying in advance. But you have to be right. The warrant has to come into the money before it expires. So there is a level of risk there. It's not something I'm doing in the portfolio right now. It's something that I would say is something you should only really dabble in if you know what you're doing. And stock selection still matters. Due diligence still matters. If you can say there's a company that's trading for $1, you can buy the warrant on a tradable warrant on the market for 25 cents, but the warrant's exercisable at $2. You can lose that 25 cents. The stock could go up from $1 to $1.50, or even $1.75. It could be a great success, but it never reaches that $2 that brings that warrant into the money, and you still end up having wasted your 25 cents. So you really need to know what you're doing. Personally, my favorite way of getting warrants is just to participate in a private placement. And this can be another huge topic. In fact, I have written a report, an in-depth report on private placements, because it's such a big topic, and we are putting the finishing touches on that and should have it available. This will be a free download, like the pre-production sweet spot report that's available for free right now on our website. There will be a free download where we'll get into a lot of the ins and outs of participating in private placements. I do think, and I guess something to consider here is, I'm trying to build a fortune for my readers by being right more often than I'm wrong. I'm not trying to swing for the bleachers on grand predictions. I'm not even thinking about 100 baggers. I am aware of 10 baggers. I'm just not trying to do that. I am trying to act more like an investor than a speculator almost, even though I am speculating. I'm trying to deploy capital into speculations that I think have high odds of delivering large gains for me. That's what I'm doing right now. And so far it's working. But that's not how my teachers, who when I first came into this business, built their fortunes. Most of their fortunes were amassed participating in private placements. Because when you buy into the private placement, you usually get a unit in the private placement that comes with a share and a warrant. And the warrant is an option that you have the right but not the obligation to exercise. So when the warrant comes in the money, you already know it's a winning deal. The stock you may or may not hold. You can sell the stock after a hold period. You can get many times a lot of your money back, or you can profit on the stock itself. But it's really the warrant that is the basis of a lot of Doug Casey's wealth for sure, and others that I know of in the business. So this is important. It's certainly something that I keep an eye on for my readers. If I like a company as is, again, you can't just buy because there's a private placement. That doesn't guarantee a win. Due diligence still matters. The company still has to deliver. The share price has to go up for those warrants to be worth anything at all. So due diligence still matters, and it is something that I bring to the attention of my readers when appropriate. But I just want to say, this is a big deal. It's very important. I have a report that I'm working on this, and it will be available for free to everyone soon. Quick question. Do I speak Russian? Da, no только немного. I speak enough to get in trouble. Question, what about oil? I think I covered this a bit with the coal and the shipping, industrial commodity. I haven't had any oil in my portfolio since becoming the independent speculator, excuse me. But I guess maybe, so the big picture here is oil's not done. I think there will be a lot of money to be made on the oil patch going forward in the right market environment. I think there are juniors that can make discoveries and deliver terrific wins for speculators who back the right exploration plays in that space. The reason why I haven't gotten any oil plays in my portfolio at all is not that I don't like oil as a speculation or that I don't understand it as a resource. I think I have a pretty good understanding of oil as a resource. It's just that I've not been bullish. We have seen oil fluctuate up and down. I've missed some rallies in the oil space, but those are all based on voluntary supply cuts. As long as oil is in a situation where there's too much of it, I mean, honestly, we still have an oil glut. We have, to the degree that we've had any joy in the oil patch at all, it's been because of voluntary production cuts. And we just saw last week how fragile that is as a premise for investment in this space. So what would get me back into the oil patch would be, one, any fear of global economic recession is in the rearview mirror. I want to see a booming global economy, and I want to see either supply discipline, or ideally, no need for supply discipline. I want to see actual demand outstripping actual supply, whether or not the Russians and OPEC can agree or not. And until I see those kinds of conditions, I just see it as too risky. Can there be money made there? Absolutely, no question, lots of money. But again, I'm not in the prediction business. I'm trying to look at trends in front of me. And right now, I just can't see this trend as my friend. I have a question here. A few more minutes until it's 2 hours. I think we'll call it quits at 2 hours. That'll be a good record. Do I ever do pair trades? I don't have any on now. I have written about them in the past. Back in my Casey days, I do remember a couple times where there were pair trade ideas that were quite compelling. My experience is that most readers don't like pair trades. Most people just want to be told what to buy. Most people don't even like options. They just want to know, what do I think is, the best stock that's either going to be, your 10-bagger, the biggest win, or that has the best odds of delivering a solid win. That's what most people want. Pair trades, a lot of people, they just don't like the idea that one's going to go down, that they're going to buy one and one's going to go down, the other's going to go up. When I have written about a pair trade, it's been an asymmetrical risk. It's been when I think, okay, I think X is going to happen. If X happens, if I'm right about X happening, then this thing is going to go up 10 times and this thing's going to go down 10%, right? Yes, I'll lose money on this one, but this will go way up. And if I'm wrong, I don't have the gain here, and I'm upset with loss there. I might have a gain over here on the one that would go down if X didn't happen. I want to see a huge and obvious, incredible asymmetrical risk situation for a pair trade. I'm bullish on this, and I want to offset it with something that would be a contrarian. It's very easy to get that wrong. I think it's, I might try it if I was a private trader without anybody looking over my shoulder, but I'm reluctant to put on a pair trade, which could go wrong on me. And have that be part of my track record. Particularly, I only launched the independent speculator in 2018, so I'm still pretty early days here, and maybe I'm right or I'm wrong, but I'm trying to focus on things that I believe have a very high probability of delivering big wins. Maybe not the biggest ever, but big enough wins to matter, but high odds. And once I've really set myself up, if I was as famous as Doug Casey, maybe I wouldn't have to do that. People would buy my newsletter anyway. But right now, I've really got to deliver the goods. I've got to show a track record that shows I know what the heck I'm talking about. And I just don't want to have any losers I can avoid. So no pair trades on my public track record for now. But conceptually, I think that is smart if you know what you're doing. And if you can see a situation that's clearly asymmetrical like that, where your pair trade hedges against something, but if you're right, you win big, then sure, why not? If you know what you're doing, go for it. All right, ladies and gentlemen, that is 2 hours of uninterrupted Lobo Loco independent speculator here. I'm sorry for the questions I didn't get to. It's undignified for a wolf to turn horse. But as I said earlier, I will start answering questions in the free weekly digest, general questions, specific stuff to the subject matter of our newsletters I will reserve to paying customers. But many of the types of questions we've discussed today, I will try to be more helpful to you, and I will add a Q&A section to that free weekly newsletter. If you're not subscribed, I don't spam you, I promise. It really is a weekly newsletter. Ladies and gentlemen, thank you so much for listening today. We will put timestamps on this to help people in the future. If it didn't answer your question, I apologize. I will try to get to it as soon as I can. Thank you very much and have a good day.